Hi everyone, I'm Debbie Roberts, owner and financial advisor at Property Apprentice. Join us today for the weekend review where I talk about current events for the everyday investor and home buyer. Topics for this week. Topic number 1 from Oneroof on the 22nd of May, First Home Grant axed, what the government changes mean for first home buyers. Second topic from One News on the 23rd of May, record numbers are leaving New Zealand, but is the grass greener overseas? Topic number 3 from interest.co.nz on the 21st of May, Crown Housing Agency may have to bid against private housing providers to secure funding for future state homes. Topic number 4 from Good Returns on the 23rd of May, good and bad news for homeowners from RBNZ. And fifth topic from Newshub on the 21st of May, Bay of Plenty more expensive than Auckland for renters. So first up this week from Oneroof on the 22nd of May, First Home Grant axed, what the government changes mean for first-time buyers. The government has announced the end of the First Home Grant scheme, which provided financial assistance to first-time home buyers. Housing Minister Chris Bishop stated that while Kāinga Ora will no longer accept new applications, it will process existing ones. The grant, averaging $5,000 for eligible buyers, was deemed too costly and ineffective. However, the First Home Loan Scheme, allowing buyers to purchase with a 5% deposit, will still remain. Earlier this week, Bishop expressed concerns about Kāinga Ora's financial performance and governance. As the country's largest landlord, it manages $45 billion in assets and spends over $2.5 billion annually. The review by former Prime Minister Bill English recommended increasing social housing provisions by various providers, sparking fears of privatisation. The First Home Grant offered $5,000 per person for existing homes and $10,000 per person for new homes for buyers meeting income thresholds of $95,000 for singles and $150,000 for couples. Alan Lailoi, a financial advisor, emphasised the importance of these schemes in helping many families buy their first homes. The larger grant for new builds was seen as economically beneficial, and the 5% loan scheme was crucial for those without a 20% deposit. Leslie Harris from the First Home Buyers Club criticised the lack of a strategic government plan for first home buyers. She called for a dedicated first home buyer minister and better cooperation with banks. Harris highlighted the long-term consequences of failing to secure home ownership and questioned whether the government prioritised first home buyers. Calvin Davidson, CoreLogic's chief economist, and Jared Kerr, Kiwibank's chief economist, stressed the need for more houses overall. They argued that both government and private sectors need to address the housing shortage. Davidson noted the importance of low deposit finance and KiwiSaver access, while Kerr pointed out that the country's strong net debt position and the need for infrastructure investment to boost housing supply was a bigger issue potentially. So my thoughts on this are, with up to 95% lending still available for first home buyers and lending criteria is relaxing at the moment, there's a pretty good chance that as a first home buyer, you might not need that extra government grant. And certainly in times like this, where there's not much money left in the pot, it's responsible, in my opinion, for the government to look at different ways to trim spending. So, just if you are a first home buyer looking to use that first home grant, don't lose hope. Just because you're not going to have maybe 5 to 10 grand for the deposit and help from the government, there is still plenty of different options available to you. So just talk to your mortgage advisor. Second topic from One News on the 23rd of May, record numbers are leaving New Zealand, but is the grass greener overseas? New Zealand lost over 1,000 citizens per week in the year ending 31st of March, amid economic contraction and rising unemployment. 1,000 citizens a week. Stats New Zealand reports that for every citizen returning, 3 left, leading to a net migration loss of 52,000 citizens. Conversely, the country saw a net gain of 163,000 non-citizens. During this period, New Zealand faced a recession, a 25% drop in new dwelling consents, rising rents, 4% inflation, and anticipated unemployment exceeding 5%. So thankfully, it does look as if the net migration is slowing down. So, but unfortunately, we do still have a large number of Kiwis leaving to go overseas. Economic conditions in popular destination countries, Australia, unemployment rose slightly to 4.1% in April, which was above the expected 3.9%. Job vacancies dropped by 6.1% from November 2023 to February 2024. Inflation, the CPI in Australia rose 3.6% year on year to March 24, driven by higher rent and education costs. Rent prices, median weekly rent increased 8.5% year on year to $627, which is a higher median rent increase than what we've seen in New Zealand. GDP grew by 0.2% in the December quarter. For the United Kingdom, unemployment increased from 3.8% in late 23 to 4.3% in early 24. Job vacancies fell 2.8% from February to April, with declines in 13 of 18 sectors. Inflation dropped to 3.2% in March 24 from a peak of 11.1% in October 22, and that's expected to fall further. Rent prices, monthly rents rose by 9% in Wales, 10.5% in Scotland, and 10.1% in Northern Ireland, which is considerably higher than rental increases in New Zealand. GDP increased by 0.6% in the first quarter of 24 after two consecutive quarterly declines. In the United States, unemployment seems to be holding steady at 3.9% in April, ranging between 3.7 and 3.9% since August 23. Inflation, CPI rose 3.4% in April, which is slightly down from 3.5% in March. Real GDP grew at an annual rate of 1.6% in the first quarter of 2024. In Canada, unemployment is at 6.1%, higher across all major demographics compared to a year ago. With inflation, their CPI increased 2.9% year on year in March, up from 2.8% in February due to rising fuel prices. Their rent prices, average monthly rent jumped 10.5% in February, with Alberta experiencing a 20% year on year increase. Real GDP grew 0.2% in the last quarter of 2023 after a 0.1% decrease in the previous quarter. New Zealanders are facing tougher competition for fewer jobs and houses, prompting many to seek better opportunities abroad. The economic conditions in their destinations reflect varied challenges and opportunities, with many grappling with unemployment, inflation, and housing costs, just like we are in New Zealand. So if you are one of the people that are thinking about relocating overseas, might be a good idea to do your homework on what's happening in those countries as well, because the grass is not always greener on the other side. And we haven't even talked about the different taxes or, things like stamp duty. For example, in Australia, if you purchase an investment property, it's liable for capital gains tax, plus you have to pay stamp duty on the purchase as well. So if you'd like to learn more about investing in property in New Zealand, join me at one of our free events called How to Succeed with Property Investing. I'll be discussing strategies for successful investing from my perspective and as an experienced investor and a financial advisor. And these events are available live, online, or in person. Check out propertyapprentice.co.nz for upcoming dates and register today. We don't sell property, so it's all about increasing your knowledge to reduce your risk. If you've already been to one of our free events and you'd like to find out more about how we can help you to reach your financial goals, you can also book a no obligation phone call or meeting with my husband, Paul Roberts, via the website. Third topic from interest.co.nz on the 21st of May, Crown Housing Agency may have to bid against private housing providers to secure funding for future state homes. The government's housing agency, Kāinga Ora, is set for a complete overhaul after a review by former Finance Minister and Prime Minister Bill English revealed it requires billions in new funding to remain operational. The review highlighted that Kāinga Ora is not financially sustainable without substantial government cash infusions over the next 4 years. Treasury's forecast indicates an operating deficit of $700 million by 2028 due to higher interest on debt and increased staffing costs. Internal projections show debt levels could grow from $12.3 billion to $23 billion by 2028, necessitating over $21 billion in government funding to cover operating losses and capital expenditures. Governance issues were a significant concern in the review. The weakened governance and low levels of accountability at Kāinga Ora were cited as key contributors to its forecasted deficits and debt. Despite increasing its ability to build better homes, Kāinga Ora's costs have escalated significantly. The review found that the agency's redevelopment costs were $35,000 more per home than those led by private developers, excluding land costs. And, by the way, previously we've seen reports that showed that Kāinga Ora, when they were at auctions bidding on property to do these developments on, they were authorised to purchase the property at up to 10% higher than the top bid. I mean, wow. This inefficiency has raised alarms about its financial management and sustainability. Shocker. In response to these findings, the government is planning substantial changes, which are well needed. The current board, led by former Labour MP Mark Gosh until February, will be replaced by Simon Muta and refreshed in July. The new governance team is tasked with presenting options to reduce annual losses and avoid excessive debt by November 2024. Additionally, the government may invite charities and private investors to bid for housing contracts, introducing competition to improve efficiency. This move could see the Ministry of Housing and Urban Development contracting Kāinga Ora or other providers based on who offers the best value for money. I mean, that sounds like a logical decision to me. The potential introduction of competition in housing provision could subject Kāinga Ora to greater scrutiny and pressure to perform. If the agency underperforms, the government could allocate funding to other providers, levelling the playing field by stopping subsidies for Kāinga Ora's operating losses. This shift aims to force the agency to be more efficient and accountable. It is taxpayer money after all. Political reactions to these plans have been mixed. Opposition parties suspect a potential sell-off of state homes, which in my opinion is scaremongering because Housing Minister Chris Bishop denies these plans. Bishop emphasised the need to focus on housing vulnerable New Zealanders and not get distracted by additional tasks. Green Party spokesperson Tamitha Paul criticised the government for prioritising short-term finances over solving homelessness. However, I would just like to say a major solution towards that problem is to provide more rental properties, and private landlords are the most efficient way to do that. Labour's Kieran McAnulty highlighted their addition of 14,000 public housing units and stressed the importance of government funding in addressing the housing crisis. Amid these challenges, the broader economic context is also a factor. Finance Minister Nicola Willis aims to keep net core Crown debt between 20% and 40% of GDP. It's currently at 43.5% and expected to decrease. The significant changes at Kāinga Ora reflect the government's effort to improve its financial stability and operational efficiency, potentially involving more private and non-profit sector participation in social housing provision to help fix that homelessness crisis. Topic number 4 from Good Returns on the 23rd of May, good and bad news for homeowners from the Reserve Bank of New Zealand. So as you know, it was the OCR announcement. The Reserve Bank's latest monetary policy statement delivered both positive and negative news for residential property owners. On the downside, the likelihood of the first cut in the official cash rate has been pushed out from the June quarter of next year to the second half of 2025, possibly even the last quarter in their monetary policy statement. So while there is another possibility, there is a possibility of another hike this year, Governor Adrian Ord dismissed claims of an 80% chance citing limited risk tolerance for economic data surprises. RBNZ's projections now suggest that the OCR will peak at 5.7 in the December quarter of this year, which is an increase from 5.5% since May last year. Despite market expectations of rate cuts, the Reserve Bank of New Zealand sees average mortgage rates nearing their peak at 6.5%, with recent bank cuts factored into the projections. And they also made a comment about how they were quite comfortable with the fact that banks have been reducing their interest rates as well. I'll tell you my thoughts on this at the end of this session. The impact of OCR is most significant on floating interest mortgage rates and diminishes on longer term fixed rates because they're more influenced by global interest rates. On the positive side, Reserve Bank notes inflation easing on housing and construction costs. Although they still remain concerned about domestic inflation pressures, such as things like increased rents and increased insurance costs and increased rates, council rates. Lower price increases in construction contributed to declines in housing costs, but rental inflation remains historically high. Don't get me started on the reasons why. Reserve Bank sees rent inflation staying high in the near term due to strong migration-led population growth and slower new dwelling construction. Reserve Bank of New Zealand also rates rentals as moderately responsive to monetary policy, while local council rates, insurance, and household energy costs are seen as less responsive, as per a special topic box in the statement. So, my thoughts on the OCR announcement and the language that was used is that it's not surprising that the Reserve Bank governor was using strong language, which can be quite scary. So, this is literally their job, is to set the tone of expectations in the market as well. So it's not just what they say, it's how they say it. And they certainly are still in this worrying phase as to whether or not they have done enough yet. So my opinion on this is that I think that there is still enough pain in the market that there is more chance of a decrease in the OCR before the end of this year than there is a chance that they're going to increase. Obviously, it will depend on the actual data as and when it comes in. But for this announcement, I don't think anyone was expecting a decrease. No big surprise that they left it unchanged. The surprise seems to be in the language that was used about a potential increase towards the end of this year. But, time will tell, and we just wait for that data to roll on in to help them make the right decision. Topic number 5 from Newshub on the 21st of May, Bay of Plenty more expensive than Auckland for renters now. The Bay of Plenty emerges as the priciest region for renters nationwide, with median rents approaching $700 per week. That's surpassing even Auckland's median rent of $680 a week. Overall, the national median rent remains steady at $650, reflecting a stabilisation in rental prices. While some regions, like the Bay of Plenty, Waikato, Taranaki, Wellington and Otago, witness modest increases in median rents, others, such as Nelson, Tasman, Auckland, Northland, Hawke's Bay and Manawatu Whanganui, experience slight declines. TradeMe's Property Sales Director, Gavin Lloyd, acknowledges the concern this may raise for renters, particularly in Tauranga, where the median rent hits a record $730 a week, ranking the third highest nationwide. However, there's a glimmer of hope as supply catches up with demand, which will lead to a positive trend for renters. With an 8% increase in supply and an 8% decrease in demand from March to April, the rental market may see more stability in the near to medium term. The current property landscape presents a promising environment for those that are looking to invest, upgrade, or transition in the real estate market. Join me at one of our free events called How to Succeed with Property Investing, and you'll learn more about the opportunities that are available today. But remember, we don't sell property. During these 2-hour workshops, we cover recent property market data, and as an experienced property investor and financial advisor, I'll share valuable insights and expert tips to help you on your journey. Our free events cater to all levels of property investors as well as first home buyers. And I'll tell you more about how we can help our clients to achieve their financial goals. So if you're interested in finding out more about what we do, visit propertyapprentice.co.nz today to secure your spot and register for one of our upcoming events. Alternatively, book a no obligation phone call or meeting with my husband, Paul Roberts, through our website. That's propertyapprentice.co.nz. Thanks for listening.